emergence of new banking entities, challenges and opportunities for existing players. All of you are aware that in September 2013, a Committee on Comprehensive Financial Services for Small Business and Low-Income Households was headed by Mr. Nachiket More, and that committee submitted a report in 2014. In August 2015, Reserve Bank of India gave in principle license of 10 payment banks and 10 small finance banks and 11 payment banks, and 2 of these entities have already started operation in this area. The objective of setting up this payment bank was to further help the financial inclusion by providing small savings accounts and payments and remittance services to migrant laborers, low-income households, small businesses, other unrecognized sector, and other users. The aim at which small finance banks were set up is being set up to furthering financial inclusion by provision of savings vehicles primarily to unserved and underserved section of the population, and supply of credit to small business units and small marginal firms. Apart from that, Reserve Bank of India has also announced that now bank licenses will be available on tap. So many more entities are likely to join the fray, and there will be a environment where new entities will cover new types of business model, new technologies, and the existing players will have some issues in the sense that they will have to have their business done maybe in a different way than what they are doing now. So under this context, there are challenges, but at the same time there are opportunities as well. So we are very fortunate to have here with us very experienced bankers. We have Madam Rashna Murindare here. She is the MD and CEO of SBI Capital Markets. Mr. Ashwini Behera, Deputy Managing Director and CEO of State Bank of India. He just retired. State Bank, as you know, is having about more than 2 lakh employees, and he is the person who was responsible for HR function of the bank. So he comes with a lot of experience in this area. We have with us Mr. Ramesh Singh. He is Executive Director of Dena Bank. He joined Central Bank of India in 1983 and then became General Manager with effect from 1st April 2013. He was Field General Manager in Bank's Bhopal Circle, and then he had also assumed other important responsibilities of the bank. He took charge of Executive Director of Dena Bank from 22nd of January 2016. So he has, he has a lot of experience in the banking arena, banking environment. So we are very happy that Mr. Singh is also here. Welcome you to this panel discussion. And we have Mr. Shashank Dasaka. He is Head of Rural Banking and Sales in Axis Bank. He has been with the bank for quite some time and spearheading the activities in the Axis Bank. So he brings with him a lot of inputs or insight from the way a premier private bank works in the Indian banking environment. So we are very fortunate to have him with us. Welcome you to the panel discussion. To start this panel discussion, I request each of the members to speak for a few minutes on the subject of their choice. First, I would like to invite Madam Vaishna Purandare and request to give her overall views on the subject of this panel discussion.
Thank you, sir. And respected panelists, dear friends. As I am coming first to the straight away over here on the topic, which is emergence of new banking entities, challenges and opportunities for existing players. Now, the first thing that I want to talk about is the evolution of Indian banking industry. If we look back for the last, say, 100 years or so, we see that we can divide the banking industry evolution over 4 phases. The first phase was up to 1950, when pre-nationalization phase that we call, before the 1955, when SBI was formed, and just before that the Banking Regulation Act was passed. Then from 1950s or 55s, whatever way you want to say, till about 1990, this was the consolidation and the nationalization phase. When what happened was banks were, there were 21 banks nationalized. There was SBI, which came in 1955, then there was the 7 subsidiaries of SBI, then the 14 banks, and then the 7 banks. So this was the consolidation and the nationalization phase. And the third phase was the introduction of the financial and banking sector reforms, which started in 1990s and went up to 2004. And after 2004 is the period of increased liberation, which is a liberalizing of the banking sector, which we are all aware of. Now, many of you, if you have been in the banking, and obviously the way I look at it, I'm sure most of you have been in the banking industry now for the last 10 years. And if you have been in the banking industry for the last 10 years or more, you would definitely have seen that there is a substantial shift that has happened. The way we did banking 10 years back and the way we did banking today, 10, 15 years back, the way it would be from each bank. So the change that has happened is substantial. I hope all of you agree on this. There has been a lot of technology which has started working. The first thing that happened was the core banking, which is a technology platform which came in, and all of us struggled to learn how to work on core banking, and we had to develop our skills or get reskilled to do this business. So the 1992 onwards to 2004, and since then, what is it that has happened? What has happened is that there has been a lot of alignment with the global developments and standards. So because there is a lot of alignment which is happening with the global banking scenario, and because of the alignment of the standards, and as also what has happened is a lot of new players have started. There is something called as the technological disruption that everyone today is talking about. Everyone, it is chronicled, I think, and it is well known to all of us. We are facing it in each phase of our life today, not necessarily in banking, but particularly in banking, it is changing a lot of things. So once this liberalization started happening, what happened was that we started getting aligned to the global scenario. And when we started getting aligned to the global scenario and to the global standards, we needed to meet them, right? And the regulatory oversight has also started increasing. And then came the issue of capital requirement, all the Basel III requirement that we are now facing, information technology, the MIS that we require, to keep competition at bay. So then the Indian banking scenario started seeing a substantial change in the way they started looking at business. So when this competition, both global and from other, particularly non-banking entities also, like your Paytms, like your IT people started giving that PPIs, prepaid instruments. All this has led to the banks rethinking their strategies. So the banks have started realizing today, the existing banks, that we need to have a change in the way that we do business today. We cannot do business the way we were doing business. Previously we had a standard set of business. We would take deposits, maybe time deposits and call deposits. We would lend money, maybe by way of cash credit. Bill discounting was one of the earliest ways of funding the customers. Then came the term loans and cash credit. So the core business of the banking industry was deposit taking and advances lending. And the difference between the two helped the banks to make their profits. However, with the disruption that came in by way of liberalization, where a lot of other entities started working with the same customer to wean them away from the banks for a certain product which they were very competitively able to give, where the customer, they were able to find what the requirement of the customer was, what his expectations were, and deliver them very fast. So there came a factor of identification of his needs, to the fast delivery that happened, and 3, with the least of the cost. All this disruption and with a different process. So all this, when it started happening, the banks realized that the best of my customer is being taken away by other banks, who are the new banks. Like Dr. said, it was the new banks who did not have a baggage, who did not carry the NPAs or other institutional baggages which were there for a long time. These people started outbeating the existing banks. And then the banks started realizing that we need to relook at our structures if we need to be remaining competitive, if we need to increase our growth rate, if we need to have the profits that we need to, if we need to increase our profits. So they started focusing on the cost, which before 10 or 15 years I am sure no one of us ever looked at. We started focusing on the cost. We started finding out the capital requirement, whether I wanted to do a fund-based limit or whether I wanted to do a non-fund-based limit. What is the capital that I am employing when is required to be employed, and what is the return that I am getting. So we started moving from the top line to the bottom line. We started looking at the capital requirement. We started looking at what is the technology adoption that we need to do. So customer-centric, the banks started becoming customer-centric, and in that process they started also updating themselves. They started, the old practices started changing, and we started working in a new way. So we started a business rethink, a business strategy rethink, a risk-taking capacity or capability of a bank started coming to the fore. Now all of you are in the bank and all of you know what our public sector banks are today facing, right? And this is now playing on most of the top managements in banks as to what is the risk mitigation methods that we have developed. Where is it that we need to go to get a sophisticated risk tools to take care of the activities that we are undertaking. So the banks started thinking about not only customer-centric, not only cost reduction, not only on profitability, they also started thinking about real returns by way of proper risk mitigation products or tools used when they are doing funding or when they are loaning out to the customers. So this is a new change, paradigm shift that has happened. And now in this process, so this process I think everyone is aware of. This is nothing that I am saying new. But in this process, many banks have started realizing that there is a vast, what can I say, there is a vast range of activity that I can handle, and I not necessarily have to handle the entire, from end to end, the entire range of all the activities that are undertaken in the banking. And this may be forced upon the banks for various reasons. It could have been forced upon the banks because the capital is not sufficient. Two, because their expertise or in that product is now no more there because new products have come. Their innovation is not happening to the level that the market is doing. Three, the market area that they have, the geographical area that they are working in is limited. So this is something that the existing bankers have now started looking at. They've started looking at what is my structure, what is my model, whether my model will work if I am a universal bank. If I am a universal bank, then if I want to remain in the entire range of activities, do I have the capital to do it? Do my people, do my personnel have the right kind of skills and abilities? Do I need to reskill my people all over again? Or if now that like Dr. Mishra said, we have now got those small banks, we have now got those payment banks who are not going to look at the entire range of products in the banking. They are planning to look at very niche products. Small banks will do all the three activities of deposits, advances and payments. However, they will do it restricted to a region. They may do it restricted to 2 or 3 products. So this is the difference between a universal bank and a small bank. The payment banks, as we all know, are going to be exclusively in taking deposits and making remittances or payments. So whether as the top management of every bank will now necessarily have to sit down, rethink, find out where they want to be in this space. If they think that they want to be in the entire range of products, then whether you have the capital, whether you have the right skills, whether we have the geographical presence, or like small banks, we want to restrict ourselves to a region and still work at that. This is something which will be thought, and according to me, which will be one major decision that the banks will have to do in the near future. And another aspect of it is they will also have to start innovating. We for a very long time stayed with standard products. The new banks which are coming in, and not necessarily the banks, even financial companies outside the banking industry are ensuring that they come out with new products. They are coming out with innovations, both not only in products but also processes and way they do business. So the banks will now also start having to look at way to do new business, new products. So there is a lot of innovation that will need to happen in the banking industry. And this is a very big challenge that today's bankers will face. So you have here an area where not only your business, there is new scope for business, there are new products for business, but at the same time it is challenging because you are not up to it maybe. And therefore your existing customers, nowadays there is nothing called as a relationship banking. All of you are now in banking and you understand that if I am a bank who is giving my customer say X rate of interest and another bank gives him a X minus 1%, 0.5%, he will simply switch banks. It is happening, and it is happening particularly in all the top rated banks. So not only will we have to be, and if we have to match that X minus 0.5 or whatever that the new bank is giving, because he does not carry all the baggages that the existing banks have. So then we have to cut down our costs. We have to look at alternate methods where we can increase our fee income. And that is why if you see most of the banks and even the bank analysts these days talk about fee income. This is something, because when you do advances, you require to keep capital, and now capital is becoming very scarce. So you need to look at alternate business. So then there is the fee income. So that is what another thing that will happen, that new products will come into being. All cannot do infrastructure funding. We have seen what that has led to. The infrastructure funding has led to many a crisis in many a banks, and therefore we need to take a call which kind of business we need to do, and we also need to know that which part of the spectrum we need to be. Now another thing is there will be a differentiation within the universal banks. There would be some universal banks like 2, 3, 5 maybe big ones who will still have the capital to grow after having taken care of all their systemic issues, and they will have to develop the capabilities, the infrastructure funding capabilities, because this is infrastructure funding is going to remain one big area irrespective of whatever is happening today. I know most of our banks are today shying away from doing infrastructure funding, and obviously because of all the baggages. But going forward, that's going to happen. If the country has to grow, if the country has to take a GDP above 7, I think infrastructure funding will be a requirement. And if infrastructure funding is requirement, in spite of all the other alternate funding that is going to come in, banking as a major funding will have to remain. And for that, each bank will have, at least the universal banks will have to think about what are the areas which I need to reskill myself. What are the new risk assessment, new risk mitigation tools that I require. So all this is, so there are going to be a few banks who will be in niche areas. There is something going to be now, the way I see it, it's going to be that there will be a bank, like what is happening abroad, that there will be banks who will underwrite the entire big loans. And these banks will then downsell to the small banks. So these small banks will not have the capabilities of maybe risk identification, structuring the product, risk mitigation tools, but the underwriting bank will sell down that to these ones. So these are some new products that are likely to come. Now there's also, if you are seeing, there is a lot of synergy that is going to happen between the small banks, the payment banks and the universal banks. The payment banks which will be basically serving the rural areas, the unbanked areas, the unbanked or underbanked people will start tying up. And I am sure all of you know that there is a lot of tying up that is happening with the universal banks to sell the products. So this synergy is another major change which will come between universal banks and the small banks or the payment banks. So in the next 3 to 5 to 7 years, I think it is going to be really challenging for the banks. Simultaneously, it's also going to be very interesting and to be in this industry. There has to be a lot of reskilling. There has to be a lot of attitude change that needs to happen. Because if we have to do a lot of reskilling, and this is something particularly for the public sector banks, we need to reskill ourselves. We need to have a change in attitude. We cannot do business the way we were doing business earlier. I cannot say today, for the last 30 years I have done this business, so if I will continue to do this business. If we keep having that attitude, I think we will definitely lose major share. So there is a scope for everyone to be surviving in this scenario. There is a scope for the existing banks to survive. There is a scope for the new banks to survive. There are new products coming up. There are new areas, new business developing as per the requirements. Because today customer is becoming very demanding. Customer is also becoming aware of the new requirements that he has. Today, because of the demography that India is, 30 years back or 40 years back, we would spend money only if we had the money in our pocket. If you go back to your parents or maybe your grandparents, the first thing they said is, if you have money, save, and only then whatever is left you can spend. Today the generation doesn't talk like that. Today the generation says, I'll take a loan. I'll take a loan which is 1 time, 2 time of my income. I'll take a house within the first 5 years of my starting with work, and I have a lifestyle that I want to live, and as per that lifestyle, I may require debt. So there is a change, perceptible change in which the new generation looks at. So because of that, banking does have a big, large scope, and I'm sure that there are challenges for the existing banks, but if we take care of these challenges, for which there has to be an attitude change. You cannot say that I'll do it this way and if not, no other way. So if we take care of these things, I'm sure the existing banks will also be able to survive.